This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, August 3, 2026, and this is the New York session. Now, let's get into it. The VIX is sitting at 15.99, practically asleep, while the Fear and Greed Index has crashed to 14 out of 100. That is a chasm of dissonance. Traders are terrified, but options markets aren't pricing it in. We're watching the dollar-yen collapse to 156.512, a minus 0.68% drop that's triggering massive flows, while gold holds at 4,065.75 despite institutional shorts. Tonight, we dissect the mechanics of this safe haven rush and the structural break in the carry trade. Looking ahead, the calendar is relatively light, but the concentration is sharp. On Tuesday, August 4th, we have three key data points: durable goods orders, JOLTS job openings, and the trade balance. These are all U.S. figures. Then, Wednesday, August 5th, brings the ADP employment change. And finally, Thursday, August 6th, is the heavyweight, the Bank of England's rate decision. We'll touch on why that specific date matters for sterling as we move through the pairs. Here is the snapshot as of 19:15 ET on Monday, August 3, 2026. The dollar is grinding higher, led by dollar Swiss at 0.80901, up 0.25%. But the real story is the yen's weakness, with dollar yen at 156.512, down 0.68%. Gold is static at 4,065.75, down a fraction of a percent. The broader market context is mixed. Headlines from the previous U.S. session mentioned risk-on returns, yet our current data shows a brutal flight to quality. Let's dig into what's actually moving the tape. First, let's look at the macro pressure cooker. We have conflicting narratives everywhere. Palantir reported a 93% revenue jump, and HSBC is calling the chip sell-off rotation, not capitulation. Yet, Amazon's Jeff Bezos sold $4.07 billion in stock. On the currency side, the Federal Reserve Chair is weighing cutting meetings, a shakeup in decades, while HSBC says the dollar is set to grind higher. Pulse, you own the macro read. What does this mess tell us?
It tells us that the market is confused about the endpoint. You have HSBC arguing for higher dollars based on rate differentials, and you have Wall Street chasing AI momentum with Palantir's otherworldly quarter. But the macro anchors are heavy. We are staring at a 3.46% CPI and a 3.29% core PCE. That is the hard reality. The 3.63% Fed funds rate is not going anywhere easily because inflation is sticking at 3.46%. So, despite the cutting meetings noise, the data supports a hawkish hold. The fear isn't about recession. It's about the inability to ease policy while geopolitics heat up.
So the fear is policy-related, not growth-related. Grid, how does that manifest on the charts? We see euro-dollar capping out and dollar-yen diving.
It manifests as a refusal to accept breakouts. Look at euro-dollar. It is sitting at 1.1531, down 0.11%. It is bumping up against a 5-day high of 1.1559. It simply cannot get through that door. Meanwhile, dollar-yen is at 156.512, hovering just 28 pips above its 5-day low of 155.229. That proximity is screaming danger. Cable is at 1.3468, which feels stuck in the middle of nowhere, between a low of 1.32787 and a high of 1.35065. The technical picture is a dollar stronghold where crosses are being rejected and the majors are getting crushed.
CIPHER, this crushing of the majors, sounds like a flow event. Who is actually buying and selling here?
It is a forced liquidation. The number everyone needs to see is the yen-leveraged fund positioning. They added 103,259 contracts week over week. That is not a drift. That is a stampede. It is a massive unwind. At the same time, DXY leveraged funds added 4,438 net contracts. You have capital fleeing the carry trade and hiding in the broad dollar index. Even pound-leveraged funds shed 40,644 contracts. It is a mass exodus from sterling and yen into the greenback.
SPECTER, this looks like a classic risk-off spiral, but your notes highlight a weird divergence. Walk us through the risk flag here.
The risk flag is the silence. The VIX is 15.99, it is barely twitching, but the fear and greed index is 14, that is deep fear. Usually when fear is that high, vol spikes. Here, vol is dormant, that means the market thinks this is manageable. But look at the mechanics. 103,000 contracts of yen longs are being dumped. That is a fire sale. When you sell that much into thin liquidity, you don't get a smooth decline, you get gaps. The VIX at 15.99 is giving you a false sense of security, while the plumbing underneath is melting down.
Let's drill down into the primary victim of this unwind, dollar-yen. It is at 156.512. Grid, you flagged the 155.229 support earlier. CIPHER, the flows are massive. What do you see at this level?
The structure is fracturing. We are at 156.512. If we lose 155.229, we are leaving the entire 5-day range behind. There is no historical support defined beyond that low on our current window. The volume is elevating, which usually precedes a break. It looks like a breakdown in progress, not a consolidation.
And it's being accelerated by margin calls. Those 103,259 new contracts, many of them are likely underwater or nearing liquidation thresholds. As the price ticks down, those positions get squeezed, forcing more sells. It's a feedback loop. The flow data doesn't show organic buyers stepping in. It shows sellers digging holes.
Add to that the geopolitical headline. We have news from Forex Live stating, Iran warns of serious risk, casualties for U.S. forces over Hormuz blockade. That headline is fueling the safe haven bid. When you combine a political threat in the Strait of Hormuz with a mechanical liquidation of yen longs, the probability of a violent flush increases exponentially. The VIX won't save you here.
Turning to the other major safe haven, gold. Gold is at 4,065.75, down 0.23%. It seems oddly stable given the chaos. CIPHER, I know you flagged a contradiction here.
Yes, it's a stark divergence. CFTC data shows leveraged funds are strongly bearish with a net position of minus 670 contracts. They are betting against gold, yet the price is holding at 4,065.75, right above the 5-day low of 3,995.98. Spot buyers are absorbing the paper shorts. Physical demand or central bank hedging is overriding the speculative shorts. The institutions are short, but the price isn't dropping. That's a warning sign for the bears.
Technically, gold is consolidating in the lower quartile of its range, which ran from 3,995.98 to 4,120.15. Support is holding at 4,047.41. It's not breaking down, but it's not rallying either. It's waiting for direction.
Apex, how do you synthesize this standoff between gold's spot resilience and institutional shorts versus the dollar-yen collapse?
It comes back to the hierarchy of safety. In the dollar-yen trade, the pressure is one-way and leveraged. The 103,000 contract squeeze is mechanical and painful. In gold, the pressure is bilateral. Shorts are there, but so are buyers. The dollar-yen trade is bleeding, gold is bracing. The flow data suggests dollar strength is the common denominator absorbing both the yen weakness and the lack of euro momentum.
Let's look at euro-dollar. It's at 1.1531. Grid, you said it's capped at 1.1559. CIPHER, you mentioned euro funds are still adding net longs. Why isn't the euro breaking out?
Because the dollar is a bigger magnet. Euro leveraged funds added 1,269 net contracts. That's positive. But DXY funds added 4,438. The gravitational pull of the dollar is stronger than the speculative interest in the euro. The buy orders for euro are being eaten alive by the structural demand for dollar.
On the chart, this is a textbook rejection. The 1.1559 level has acted as a ceiling repeatedly. Every time price approaches it, the dollar dominance pushes it back. It's a rigid barrier until the macro narrative shifts.
And the macro narrative favors the dollar right now. Your CPI is 3.46%, Core PCE is 3.29%. The ECB is not printing that kind of stickiness. The yield differential is widening in favor of the dollar. That's why the technical ceiling holds. It's not just a line on a chart, it's an arbitrage wall.
What about pound? We have the BOE decision coming up on August 6th. Cable is at 1.3468. Is there life left in sterling?
It's compressing, range-bound between 1.32787 and 1.35065. There's no conviction. Until the BOE gives a clear signal, pound is just collateralizing the other trades. It's a funding currency right now, not a destination.
Agreed, the 40,000-plus contract loss in pound leverage confirms it. Money is leaving. Unless the BOE surprises with a hawkish pivot that beats the US 3.46% CPI print, which is unlikely given the global inflation trend, sterling is under pressure.
SPECTER, final thoughts on the pound risk heading into Thursday.
The risk is a gap. If the BOE announcement is dovish, or if the U.S. data on ADP or jobless claims comes in weak, sterling could wick down quickly. But the bigger risk is the correlation with the wider risk-off tone. If oil spikes due to the Hormuz headlines, pound might act as a proxy for commodity currency weakness. Watch the correlation, not just the rate decision.
Let's wrap up with the broader sentiment picture. We have these risk-on headlines from the Americas wrap, but the live data is pure fear. Apex, tie it together. Are we in a trap?
Are in a decoupled market. The equity headlines suggest confidence, but the FX flows scream defense. The 14/100 fear index is the truth teller here. The VIX at 15.99 is the lie. The market is rotating into quality dollar and gold while ignoring the equity noise. The trap is believing the risk-on headlines apply to the current liquidity environment. They don't. The liquidity is drying up in carry trades and flowing into the dollar.
To summarize tonight, the dollar is dominating via a forced unwind of yen carry trades, evidenced by the 103,259 contract surge in leveraged funds. Technical ceilings are holding at euro-dollar 1.1559, rejecting all attempts at breakout. Gold is holding 4,065.75 despite bearish CFTC positioning, suggesting hidden spot demand. And the VIX's suppression at 15.99 masks extreme underlying stress, indicated by the 14/100 fear gauge. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.